Hi everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining us today is Matt Caruso, who's a professional trader and investor, and also one of the top performers in the U.S. Investing Championship of 2020 with a return well over 300%. Matt, thanks so much for taking the time and coming back on the show. It's great to have you.
It's a pleasure to be back, Richard. It's hard to believe it's already a year and a half since our last chat.
Yeah, I know, and so much has happened, and the dynamics of the market have really changed. So I'm really excited into getting to all of that. But for people who didn't watch our first interview, which will be linked above right now and also down in the description if you want to watch it, could you kind of give us a sense of your background and a little bit about your style and time frame as well? Because I think it's always helpful for people watching to kind of understand that, so they understand where you're kind of coming from.
Sure, absolutely. So I've been pretty much a market junkie for almost 20 years now, since I was a teenager. And I started off just really just kind of swing trading commodities, futures, stocks. But the first book that really got me obsessed with the market was How to Make Money with Stocks by William O'Neill. All that kind of like background experience got me, my first job out of university was as a professional market maker and pro trader for one of the big banks in Canada. I did that for a number of years, which was a great experience until they decided to change focus. So I decided to go on my own, and I've been trading my own company, my own capital for almost 10 years now. And 2020 I had the U.S. Investing Championship, which obviously went very well. And I now also run CarusoInsights.com, where I have education, market analysis.
Yeah, awesome. And I'll have that link down below in the comments for everybody interested. And there's a question on Twitter because I asked for questions. They're interested about your transition from trading for a bank where you're doing primarily day trading to kind of your current style and time frame now, which seems a little bit longer term, a little bit more position trading focused. So I'd love to hear your thoughts on that.
Yeah, so I really kind of stepped on everything I could. I tried everything I could in my background because I wanted to not just be a successful trader. I love the markets. So I want to understand day trading. I want to understand FX, commodities. That's why even in my early days, I was trading soybeans and I was trading Japanese yen at 2 in the morning. And finally, I had the market making gig, which was a really cool experience. And just over the years, I just, market making, even day trading, it's a lot of fun. And if you get it going really well, it's the closest you'll get to really consistent money in the market. And that's what it was for me. But it becomes a little bit of a drag of constantly keying in 100 orders a day and not being able to leave your desk. And as well, when you're day trading, oftentimes you're more apt to hit a limit in terms of how much volume you can push around short term. Like the market limits are going to come a lot quicker for you, which started to happen to me. And so I just realized if I want to be able to keep compounding my account and growing that out and really expanding into maybe other business lines or taking on capital, I was going to need longer time frames. And so a few years ago, I decided, like I say, I burned the ships and I said, I'm going to focus really on perfecting my original passion when I got into the markets was growth investing by the tradition of William O'Neill. And I took all of my understanding of very short-term market dynamics and short-term patterns. I kind of married that with William O'Neill's, basic methodology. And I kind of created what I use today, which is my own kind of hybrid system.
Yeah, that's awesome. And yeah, what are kind of those specifics that you learned from more short-term trading that you've kind of taken and translated over to that position trading style? Are there any tactics that you learned back in the day, strategies that you learned from other traders that you kind of incorporate to this day, or it's just kind of your experience and it's that overall kind of influence from that trading desk that's carried over?
Yeah, so it's kind of funny. I also did my CFA and my CMT because I really want a lot of broad education, and especially through the CMT out, you're introduced to you're basically every topic of technical analysis possible. And so as I was short-term trading and day trading and market making, I was also always running growth strategies on the side, William O'Neill's methodology. And it was just funny, at certain points, there'd be oftentimes a breakout by William O'Neill's methods. But I just knew short term, this is where I'd be shorting it as a short term trader, but I was supposed to go long as a longer term trader. So all these inconsistencies started to creep up in my mind, and I realized that, and it had me at this crossroads. And oftentimes in those situations, my short term instincts would be correct. So I realized there was, in some ways, at least for my personality, to kind of improve upon how I could actually enter the stock rather than just the basic chart patterns. But I also did notice many times where I was day trading and I had these stocks where, according to William O'Neill's bigger bases and earnings and sales and trend analysis, relative strength, they were really set up for this monster move. And I knew it, but yet I took a quick profit for a swing trade only to see the stock double, triple, quadruple. And how many times did I tell myself, oh, I'd be retired if I just would have held that initial position, and I didn't. So eventually, after enough years of this kind of going back and forth, I really sat down when I said like I burned those ships, and I built myself a manual. And I said, okay, I'm going to build this if it's in a way where I would teach somebody how to kind of bring all of this together to have the best of the short-term entries and tactics, yet be there for the bigger and more significant swings, which William O'Neill focuses on. And that's how I kind of came to this hybrid situation. And so it's really just a matter of a lot of years of experience in both domains kind of coming together. And I think most people tend to focus on one or the other. So it's maybe a little unique that I was running both at the same time. But I would say the only time I really started to really maximize my gains is when I really said, okay, I'm going to stop trying to do both at the same time, make one solid, coherent system, and put my full effort in there. And that's when I really saw not only consistent gains, but much larger gains.
Yeah, that's awesome. And I think that's a common thread in terms of people I've interviewed, traders who I've interviewed. They use that O'Neill foundation, and then they adapt it to their own style and often look for kind of early entries. They're not often trading right at that base pivot. And they're looking for lower risk entries, kind of lower within the base, where they can manage risk a lot tighter and put on a larger size, and just other tweaks that they're not trading like William O'Neill, but they're inspired by him. They're looking for those common characteristics, and they're just adapting to their style. So I think that's really cool. And I wanted to ask you, going back into your history and background, what were some kind of early mistakes that you made in your trading that you think like newer traders out there might be making the same thing right now? What kind of mistakes did you make to maybe warn those people in terms of how to fix it?
I think it's actually kind of funny, and that's why, the investing classic, Reminiscences of a Stock Operator, is always the favorite book of every, successful trader, because the path of his journey in that book, it seems like every trader, every investor goes through the same path. Whether you think you're smarter or not, or whatever it is, we're all human. We all go through that path. And I made so many of the same mistakes he made, and every trader you talk to will discuss the same mistakes. And so I think some of them, a lot of people will talk about strategy drift. And I almost did that purposely, because I wanted to learn everything I could. But every time I read a new book, I'd try that strategy. Then I'd read a new book, I'd try that strategy. So I never became really a perfectionist and got to really get the best out of any particular strategy. So that was a problem. It's good if you're in learn mode, when you really want to educate yourself and see what style works for you. But once you have a little bit of experience, 6 months, a year, 2 years, and you say, okay, I know I want to be a swing trader, or I know I want to have positions for longer term moves, then you should almost kind of stop jumping to whole new topics and just really focus on how you can maximize that type of strategy for yourself. So that's one mistake where I probably could have cut back a few years of learning if I would have done that. A second mistake I would say is people are really focused on buy points, and they want to know what's the best buy indicator, buy tool, where do I buy? Buying, I always like to give the example is, if let's say you're looking at racing or F1, if you just focused on buying, that'd be like a team just looking at top speed and not worrying about braking and agility and turning and every other pit crew. And that's only one part. So you have to really think of the whole system. And most people blow up or have significant problems, not because of a bad buy technique, but they don't have the proper selling rules, or they have poor risk management, or they don't know how to manage exposure or position sizing. And it's really, if you want to be a great trader, and it's important to be a great trader because the great traders make by far the vast majority of the profits. Being an average trader, you actually end up with poor profits. And if you really want to be great, you have to have every part of that system in place, or at some point in the market cycle, the market's going to bite you. Either it'll exploit your weak risk management, or it'll exploit your over aggressiveness in terms of margin, and you're going to pay a big price. And I think the traders who succeed long term is, over time, they're able to survive these mistakes and improve them until each part of their system works together and works efficiently.
Yeah, I think that's very true. And do you kind of had any advice for people who are just building their first set of trading rules, maybe even specifically on the risk management side of things, because that's so essential to staying in the game. And if you can stay in the game long enough, you're going to figure out the other stuff. So any thoughts on that for building rules around capital preservation and risk management?
I think if you're going to be active, you have to, there's two ways to survive in the market. One is broad diversification, which the cost of doing that is you're likely to have lower returns. I mean, if you buy the S&P 500, you won't go broke, but you're not going to have a 300% return either any year. So once you decide that, you're looking for bigger gains and you want to be more active, I think you absolutely have to obviously limit your losses. Is just so important. And you know, people have to realize, depending on your strategy, especially if you're swing trading or shorter term trading, you have to really be careful with having not only managing your risk through limiting your losses. That's one component. The other one is you have to lower your churn, your number of bad mistakes, because in a good bull market, and even though I take position trading now, I was swing trading and day trading for years, so I have experience in both realms. And the things with day trading is deceiving, because in a bull market, it's going to work really well. You'll have like a win rate of 70 or 75%. So you're smiling. It's just this great kind of cash machine. But you know, because in swing trading, your gains are not that much larger than your losses. If that 70% win rate drops down to 45, well, suddenly you're hitting major losses. So even if each loss is contained, but there's just too many losses, and now you're bleeding money, even though your losses are limited, and then you're frustrated. You eventually say, I'm not going to stop my losses short, because they end up bouncing back. And then finally that a downtrend begins, and it's an even bigger loss, and it's this vicious cycle. So I think the two ways to manage risk is, one, you want to limit your losses, which is essential. But two, you have to have a good foundation for bull markets, choppy markets, bear markets, and you have to have a filter for when to use different buy techniques, because the same buy technique that will be amazing and rock solid in a bull market or in an accumulation phase will not work the same way in a choppy or a downtrend. So if you don't have a way to identify what type of trend you're in, that in a sense is going to be a really big risk part, a big part of risk that you're not taking care of, that you don't know you need to take care of. And William O'Neill, in his approach, basically has his market rules that helped him decide when to take positions or not. But you know, just taking that same kind of logic, you need to apply what's your filter for when you're going to be taking your swing trades to the long side, or what's your filter to use certain buy techniques or versus others. And that's something that I really focused on over the years. And when I start to put great attention there, even though I'd always limited my losses, when I started to reduce that churn and that number of just getting run over in a bad market, that's when I would make a lot of profit, but then keep that profit. And that's really the big difference, because anyone can make money. It's keeping that money and constantly growing it. That's the big difference.
Yeah, 100%. And I want to dive a little bit deeper into that, because I'm sure that's a big question people have. Obviously, 2020, great for trending markets, holding positions, position trading. 2021, 2022, a little bit, definitely a lot choppier, and you're going to have to kind of adapt your style a little bit and change your buying techniques. So in terms of differentiating between different environments, what kind of guidance would you have for traders in terms of, you know, market indicators, looking at breadth? I know you love the new high, new lows. You post that pretty much daily. So what kind of things are you looking at, and maybe even analyzing your own trades, looking at your performance? What's your average gainer? What do you kind of look for to determine whether, all right, this is a trending environment, I might look for more longer term trades, versus, you know, this is a more of a swing type environment, I have to change my risk management and my sell rules accordingly?
You know, so it's funny, obviously most new traders will typically come into the market in a bull market, and that's just normal, myself included. That's what draws you in. But these really hot bull markets like 2020 are actually the outlier. It's not typically like that. And that's why most professional investors will end up getting frustrated, because you'll see these new people to the market probably beating professionals, because markets don't typically just go up, stay up, and keep going up. There's usually a lot of give and take. And so most professionals who have been through the grind are less willing to kind of hold these positions for these big advances, or aren't putting the gas on as much. And so, you know, if that's your only experience, or if you build a system only to work well in 2020, even if it would work amazingly well in 2020 or any other good trending market, that's going to be the minority of the time. So even if it works great in that environment, you'll end up getting killed long term. And that's why, you know, breakouts will work only in rare periods. But the thing is, when you go back and study and you look at the best stocks and you look historically, it's deceiving, because you say, oh, look, there's that breakout and look at that big run. But it's very easy to glance over very choppy periods or downtrends and say, oh, I wouldn't have traded that market. But in reality, you probably would be trading that market if you're trading full time. And so, you know, having been a professional trader, a short-term trader for many years, I just kind of learned that buying breakouts are really dangerous. That's what I alluded to earlier, where I said that, you know, typically would be a time to buy. I just knew as a shorter term trader that, I'd probably want to go short here, or selling my position. And so what I did, which I haven't really seen a lot of people do, is I basically took all these different patterns I use and I put them into 4 different categories. So breakouts is one, pullbacks is another, coil patterns where there's volatility diminishing is another, and expectation breakers is a fourth. And so unless we're really early in a trend, and to determine trend, I use basically what the Federal Reserve is doing, whether they're really helping the market or hurting the market in a sense. Unless we're really early in a trend, I tend to avoid breakouts because they will often fail. And so then I'll work with other techniques. But yet it's important that you have all these tools in your toolbox, because if you do run into a 2020, you want to be able to maximize those gains, because those are those rare opportunities where there's a lot of money to make. So I think that's where the trader with more experience can have a great 2020, but then after, even in choppy markets, be able to adapt and have other tools to not just get chopped up with constant breakouts. So your system should be resilient enough to work even in choppy markets, because most times the markets are choppy. So if you don't have that, most of the time you're going to be very frustrated.
Yeah, that's awesome. And I think a common issue that people are running into, myself included, especially earlier this year, is overtrading and kind of pressing setups that aren't ideal. And obviously in markets that can kind of smooth over your mistakes, like 2020, they'll go ahead and work. But in a choppier environment, like you said, a more normal environment, it comes back to bite you. So what advice do you have to prevent overtrading and just kind of pressing setups that don't necessarily fit your perfect ideal type of setup?
I think you need big picture. I think my background, like I majored in economics, and then I did all my other education afterwards. I like big picture stuff. Like when I read, even though like William O'Neill is very stock specific, I love reading stuff by like Paul Tudor Jones, George Soros, where they're trying to break the Bank of England and all these monetary different tools and situations. So I'm always excited and intrigued by that. In my early years trading pro, I'm in Canada. One of our specialty was the precious metals, and commodity markets, and especially precious metals. I mean, gold is basically another form of money, or most people will say is the best money in the world. And so when you're trading gold and gold stocks, you're actually trading more in a global macro type of world rather than individual stocks. And so for many years, I was very used to waking up and waiting for economic numbers and seeing how things are going to react to interest rates. And so I was used to looking at this big global macro picture. And so you don't have to always do all that to buy individual stocks, but you always want to have big picture and have an idea of quality setups, because that's the difference between saying, okay, look, I have this big picture setup. I'm bullish. Not only am I bullish on this stock, but I'm expecting the general market to be strong. And I have these tools that are indicating that the market may make a large move. And that sets up a situation where you have this asymmetric possibility. So by that, I mean, I'll lose a little bit if I'm wrong, but if I'm right, I have a really big runway ahead of me. Right. And by doing that, you automatically start to limit your trades, because that doesn't set up all the time. And that's one way, by kind of focusing on that. And once you lock onto that trend and it does begin, then you can kind of get in there every day and be aggressive and look for setups and add more and more and more. But waiting for that big picture view will help kind of restrain you. If you can't see any big reason why this group of stocks or this stock or the market in general is going to have this big advance, then after, maybe you shouldn't be putting on so many trades, and you should be looking at your account saying, I'm not making progress. Let me dial it back. And if you don't understand what causes these big picture moves, then maybe you should do a little more educating of yourself and seeing, what is the Federal Reserve? What are really good market tools? So you can kind of get a better sense of big picture rather than just focusing on that short term, daily chart.
Yeah, I think that's completely fair. And going back to the new highs, new lows, is that something that you incorporate into that bigger picture view to kind of give you a sense of stocks are really working right now, can press on the gas a little bit more, or, there's a lot more new lows than new highs. Maybe I should scale back and wait to press on the gas when the conditions change?
Yeah, it's a great tool. Again, you learn so many tools with the CMT designation. So it's really interesting that you learn all these things. And I learned that years ago. And John Boyk, who has a great book series, was actually started to mention it, a couple of years back on Twitter. And I started looking into it. I said, oh yeah, I remember studying this. And I really, dove really deep into it. And I said, this is such a great tool, because the general market indexes, I think, were better indicators of trend in years past. Yeah. But with the rise of big tech, where the FANG, Microsoft, Google, and the rest are basically 7 stocks make up 51% of the Nasdaq 100.
Right.
Basically, if those stocks go away, that's going to show the index. So you're in these periods of time like 2020 where the Nasdaq is going up because these 7 stocks are going up, but most stocks are falling. And so I think because of this new dynamic, by looking at the number of stocks making new 52-week highs versus new 52-week lows, gives better insight for the actual health of the market. So if we're in a nice big bull market and you go back and you study all the best bull markets, it's only logical that you're going to have more stocks making new highs than new lows. And vice versa for bear markets, you'll have more stocks breaking down. So just that really simple tool has really helped me to focus on when the market's healthy, when it's very unhealthy. And that's why even at the end of 2021, as the market made its all-time highs, you already had more stocks breaking down than breaking up. And that was just so telling of the market dynamic at that time. And I was actually, you're right, I do put like a daily note on Twitter, and I was actually mentioning at that time that we actually have a bearish trend developed despite the market all time. It was such a weird anomaly, and then the market finally broke lower. But I think it's important to have that, because most of us who are active traders or active investors, although Apple's been a great runner at a $3 trillion market cap, you're not going to get a double or a triple anymore out of Apple. So if you're trading these mid cap or small cap or small large cap companies that are 5 billion or 40 billion, using the Nasdaq 100 may not be the best guide. And that's why I like the net highs, net lows as a better guide for my market exposure.
Yeah, that's insightful. And getting back to kind of commodities and trading names related to that, I think that's something I really want to dive deeper in, especially with you, since you've got a lot of experience with it. So can you talk to us overall about kind of how to approach this if you're more used to trading, those software names, tech related names that is pretty much since I've been trading 2018 have been the leaders, but now we've got a changing dynamic where, the energy names, oil and gas, miners, steel, all these names are in super strong uptrends, while tech and most of the market are, just chopping, correcting, whatever you want to call it. So yeah, any thoughts on that?
It's interesting. I think because technology was so strong for so many years, people have associated growth with technology. But I mean, like nowhere in the word growth is the word technology, right? So really growth, and if you use kind of the explanation by William O'Neill, which is I think the founder of growth investing as the world knows it today, growth is about growth in earnings, growth in sales, a growing company. And he says 1 out of 4 companies will be a turnaround. In the 70s, he was trading oil companies. And even myself, I mean, I still like to think of myself as a pretty young guy, but when I started trading in 2004 or 5, some of the hottest stocks were titanium metals and steel dynamics, and then the energy, and it was actually really a similar market environment as we have now, because it was the rise of China and their demand for commodities. And so I think maybe because I was introduced into the market at that time, I've always been comfortable with the commodity market. But I think people have to kind of disassociate the idea that growth is tech. One day it will be technology again, because it's a great sector for growth, because technology is where most new developments come. But really try and think of growth as growth in earnings, growth in sales, rather than just technology. That's why growth companies could also be an apparel company. It could be a retail outlet. It could be a coffee store. I mean, think of other great growth stories. There was Starbucks, which was a monster grower, Home Depot over the years. So it's any kind of new concept. And every once in a while, because of more general economic factors, this booming earnings and sales will also come to the commodity sector. And that's kind of what we're experiencing now. So if you just respect the underlying logic of what growth is, you can participate both with commodity stocks or with technology companies.
Yeah, I think that makes sense. And one thing I do want to ask you is some of those charts, those commodity related charts, they're a lot choppier. They don't quite seem to trade as smooth. What are your kind of thoughts on that? And how can you kind of adapt your style so you can maybe you lower your position size and increase the stop loss a little bit? How do you manage risk in that type of name?
So it's interesting. I think the reason people have that impression is just that, if you look back at commodity stocks, they look like they're choppy and they don't go anywhere, because commodity stocks are commodities. They shouldn't be growth winners, right? If you're taking coal out of the ground, it's a pretty boring business. You're not doing anything new. But that's not just true for commodity stocks. If you bring up a chart of, let's say, Intel, which is a technology company, but it's not a technology company that's growing, right, it'll look just like a boring commodity stock, because it is a commodity. It's a technology stock, but it's a technology commodity, and it's going to be a very choppy and pretty useless stock to trade actively if you're looking for trends. And so I think you have to look past that it's a commodity. And what you have to look for is accumulation phases. So I know Stan Weinstein does a great job of looking at the different phases. And so if you, again, spend a little more time going back and looking at what are the big picture drivers. And if you look at commodity stocks during commodity bull markets, and you look just at that, you look at the start of a bull market, at the end of a bull market, and you look at those charts, they will look just like a technology stock. And if you look at a technology stock that peaks after its growth and goes into kind of decline, it'll look just like a terrible commodity stock. So it's not really about what type of stock you have, but it's where is the stock in its growth phase. It's if it's in its strong growth phase, it's being accumulated by institutions, the stock chart will look exactly the same. The same techniques will work. Everything will work. When it's not, it's going to be a very choppy and awful environment. So, I've been having a really good 2022. I've been really keyed on the commodity trend. I've been, again, tweeting about that for months now. And so if you just position yourself right, it's actually been a pretty smooth uptrend. The problem is people are always trying to implement those same breakout techniques where, they don't always work so smoothly. And I think that's the environment for commodities now in general. But if you had some, pullback entries, some coiling entries or expectation breakers, it's been a fairly good market to get exposed to with size. And the trends have been if you look at some fertilizer companies, if you look now at coal companies, yeah. I mean, some of these coal companies are as parabolic as some of those tech stocks were a couple of years ago. So it's really about, if you're going to be investing in the software space, what are the drivers of software companies? If you're investing in the commodity space, what are the drivers of commodity stocks? And how can you identify when you're in the accumulation phase of either of these industries? And that's really the key, because once you're in that accumulation phase, everything else will work the same. And when you're not, it'll be awful. So bring up a chart of Intel. It's a tech stock, but that's not a great trending stock.
Yeah, absolutely. Yeah, I think that's completely fair. And going back a little bit to the overall environment, I just kind of wanted to hear your thoughts on kind of what the Fed is doing, interest rates, all of that, because you've obviously, done the research and have more experience with that than I do. So I'd love to hear your thoughts on that and kind of the overall picture as it stands today.
So the Federal Reserve's in a really precarious situation now, and that leaves all of us in a precarious situation, to be honest. And so, as a result of COVID, the Fed brought interest rates to zero. They started quantitative easing, which is basically printing money to buy government bonds. And when they did that in past cycles, if you look at 2008 or, I think after the European crisis, they did more in 2012, they did other QE periods, QE2, QE3. It never led to general price inflation, because quantitative easing, this buying the bonds, helps financial assets. It doesn't really raise the price of milk or bread at the store. But what was unique about 2020 is that, because the Federal Reserve can't buy physical goods, all they can do is buy these financial assets. So that's great. And that actually is great for stock market, but that's why you get kind of this divide within society where the rich get richer and the poor get poorer. And it's one of the negative outcomes of the Federal Reserve supporting the general economy with this type of tool that it has. Now, 2020 was different because the federal government, not the Fed, so basically Washington and every other federal government in the world, they actually started to give money to people to induce them to spend or to help them take care of themselves during a difficult time. And so they actually created a mechanism where the money went from the Fed and not just to the market, but it went from the Fed and actually got into people's hands. So now it wasn't just financial assets that went up. Now you had all this money land in people's hands, stuck at home. What are they going to do? They're going to go on Amazon and they're going to buy products. Well, you can just print money, but you can't just print more products. And to make things worse, with all the supply chain shortages because of COVID, you had even less supply than normal. So that really causes booming inflation. And now inflation hasn't been a problem since the 1970s and early 80s. Again, because I studied economics and I just love financial history, I've really spent a lot of time studying that. And the biggest worry about inflation is that inflation isn't a problem if it's 2%, although it's not great. But if it becomes 6, 7, 8%, and people start to expect inflation, just expecting inflation causes inflation to persist and becomes a big problem. So a perfect example is if we look at prices up 7 or 8% the past year, you're going to go to your boss at the end of the year and say, look, milk's up 8% at the store, or bread's up 8%. I think I should get paid more to adjust for inflation. So your boss says, okay. And then after he turns around, he has to raise prices for the consumer of that product. And then it becomes a vicious circle. And so that started in the late 1960s because of the Vietnam War. Again, it was a war type of situation. Now it was COVID that caused it. It was a health war. And that persisted until 82. And it only stopped when the chairman of the Federal Reserve, Paul Volcker, raised rates to 20% to stop that inflation. Now, in perspective, we're at 0.75%. So we're in this really difficult scenario where you have this raging inflation, but the economy is weakening. And so the Fed doesn't want to raise rates to kill the economy, but we have inflation. That's why I think the commodity sector is so hot and has, I still think, a lot to go, because politicians are not very willing to slam the brakes on the economy, but at the same time, we have this inflation environment. And like I said, inflation, you can print money, but you can't print oil, you can't print coal, you can't print natural gas for heating. And so that's why suddenly these boring commodities are becoming huge demand as everyone has all this excess cash and they want to be able to convert it to something that won't just inflate away. And I think that's the main driver of this cycle right now.
Yeah, that's really insightful. And it's interesting because it seems like Bitcoin was kind of designed to be, the answer for this type of situation. Not necessarily the case as we've seen from the price, but I don't know how familiar or how much you're into crypto, but yeah, any thoughts on kind of that and the relationship and the dynamic between that and the market?
So it's interesting with crypto. I've seen Bitcoin from the early. I think it was like $100 and something when I first saw it. Not that I bought it. I wish I would have. But it's kind of. I was always a bit of a gold bug, just given my background in the commodity space. So I learned a big lesson with that. And when there's a new technology, you have to suspend your disbelief and try and, especially if there's price gains and the market's telling you something, you need to suspend your disbeliefs and say, okay, what am I not seeing about this trend? So I've been really thinking about the Bitcoin story for a long time, and it does have a lot of advantages. I think they're trying to kind of make Bitcoin be the digital version of gold. And I think the beauty of gold is that it's 5,000 years since people started first using gold. And if you dig up gold out of the ground in Egypt in a pharaoh's tomb, it's still worth as much as it was 5,000 years ago, which is an incredible kind of feat. And so Bitcoin trying to have that inability for people to like print money, or you can't print these Bitcoins, that's the strength. I think right now with Bitcoin, I think we're still in the price discovery phase. So unlike gold, where it's tried and tested, it's as old as humanity pretty much. It's believed and it's valued appropriately. I think the Bitcoin trend is still taking hold. I'm not 100% sold on it. I'm very intrigued by it, and I'm actually looking to maybe put some exposure into the space. But right now, because again, we're still in the price discovery phase, I think it's being viewed more as a risk asset than a simple store of value. Yeah. But I think once this market weakness ends, I think you probably will see higher prices for Bitcoin because it's really showing a use case. You can see it. I think it's creating this kind of revolution where picture yourself as a Russian citizen right now, where there's kind of like a war with Ukraine, all of this, and there's capital controls. You can't take your money out of the country, or any situation where you can't. Your government's trying to restrict capital flow. Suddenly, Bitcoin has a really good use case in that situation, and I think it's the first time since gold that people kind of say, hey, we don't really need this regular dollar type system that can be inflated and printed. We can kind of exchange with Bitcoin. So as the infrastructure comes along, when I first saw it, it was almost impossible to even buy a Bitcoin. Now it's becoming so easy to use. I'm really intrigued by it. And I think there's some really great use cases, and I'm looking to buy. I just think right now, my typical price tools are telling me, look, it's still in corrective phase. But long-term general fundamentals, I really like the Bitcoin story, and it's something I'm going to be focusing on in the future.
Perfect. And outside of Bitcoin, are there any other cryptos that you're interested in, or you're really just kind of focused on Bitcoin, which is kind of the true market leader, or the most well-known crypto out there?
Yeah, so I like Bitcoin for that reason. Ethereum, I'm starting to understand the use cases for that too. But before I dive into anything, it's easy for me to understand a company. With all these tokens and different coins, I don't have a full understanding of them yet, so I'm not really going to comment on them. I understand the Bitcoin use case, but I'm sure they all have great technology. But without any kind of earnings or sales, I want to have at least some kind of fundamental basis as to why this thing should be worth more. So it's still in the investigation phase. I'll put it that way.
Yeah, perfectly fair. And now, Matt, I'd love to go through some charts with you and
Sure.
talk about some of your trading view indicators, as well as kind of your alternate entry tactics that you mentioned, the expectation breakers, pullback entries. So yeah, feel free to share your charts and let's go through some names.
Sure, absolutely. So the new highs, new lows tool is at the bottom here. Actually, if you go into indicators, just anyone they want to use it, if you type in U.S. markets net new highs, lows, it's a tool I made available on TradingView. Anyone can kind of bring it up on their charts. And so this right here is showing the net highs, net lows for the Nasdaq. And you can see this is the Nasdaq at the end of 2021. And as we were making new highs, and we actually made this kind of gap up day, this shows that the market was actually making more lows than highs. So this is the net number. When it's below zero, we have more stocks making lows than highs. And when we're above zero, we have more stocks making highs than lows. And you can see throughout this entire correction and topping phase, internally, the market was weak the entire time. So if we have 3 days in a row where we have net lows, I have the background colored red. If we have 3 days in a row of net highs, I have a colored green. And this just did a great job of keeping me safe in this market. So, whatever positions I had long at the time, I was able to liquidate in November 2021 and didn't really put on any general market exposure, tech exposure or anything since then, really. And you can see throughout this entire downtrend, it's been very weak. The only time we actually got a little bit of strength was on this significant rally, and then very quickly we are back to net lows. Now, what I like about this tool that you can kind of switch between the Nasdaq and the NYSE, and the fact that right now the market is favoring these cyclical and commodity type names. So if we bring up the NYSE composite and we change the indicator on the bottom to reflect the NYSE net highs and net lows, you'll see it's telling a really different story. And because of the more exposure of the NYSE to cyclical and commodity names, you'll see that although the Nasdaq's been very weak and basically consistently net lows, you've actually seen a lot of periods where you have a lot of net highs. Even right now, we actually have three days of net highs on the NYSE as we record this, even in this corrective period, because there's a lot of these commodity stocks that are still making new highs on the NYSE. So not only does this tool help keep me safe, and when I see net lows, it tells me to raise cash or watch my exposure, or when I see net highs, I should be more exposed. But also being able to check between the NYSE and the Nasdaq, it helps to guide me as to where the actual strength is in the market. And just from a general macro view, is it more growth technology or is it more cyclical commodity? And if you take a look at, if you take a look back at the Nasdaq, just the great job it does in these uptrends. I'll just bring up the Nasdaq once more. This has been recently, it's been choppy and red, but if you take a look at the 2020 bottom, we were red, and this also is why in the 2020 championship I did so well, is I totally avoided the drop, and I got long very near the low because of my net high low tool. And for the entire bull market, like I said, in a healthy market, you're going to see constantly net new highs, and that's really what you had this entire bull market. So even these simple tools, these simple understandings of market dynamics, if they act like, if you think of like a street light, a red light will be very cautious, yellow or chop, careful for exposure, or green light, hey, you better get some exposure. Simple tool, but it does just a great job of keeping you focused on trend and keeping you kind of focused on how you should be exposing your portfolio.
Yeah, super cool. And like you said before, Stan Weinstein looks at this. My professor, Dr. Eric Wish, he's been this is a huge component of his GMI signal, which is kind of his general market health tool that he uses. So yeah, this is super interesting. And this graph really shows it. I mean, look at that super strong trend, and then you see the choppiness come, yeah. And we just see all those lows just kind of pile up and really reflect the change in the internals versus the externals, which is just the Nasdaq 100, which, as you said, is so dominated by just those few stocks.
Yeah, I mean, you can see that for more stocks to be making new highs down here, as the market was still way off its highs, you saw internally, wow, this is a strong market. And for more stocks to be making new lows as we're making all-time highs, as wow, that's actually a very weak market. And that's a different insight you won't get at all by just looking at the general market indexes.
Yeah, for sure. Perfect. So Matt, I'd love to go through some examples now and kind of talk through some alternate entries versus breakouts. So I think you said we'd go through BRCC, which is a recent IPO. If you want to go ahead and start with that one. This has been a fantastic young IPO. Really cool story as well.
So let me bring up BRCC here. This has been one of my really good trades here for 2022. And I still have my trend line from when I entered into the stock here. So again, this really, every part of your system has to come together to catch these trades. And I think that's why this is such a good example. So one, people were asking me, how did you find this stock in the first place? Like, it's a recent SPAC. Well, I have scans for different aspects of the market. So I have scans for earnings, scans for sales. I have scans for recent IPOs. I have scans for stocks near their 52-week highs. And so in this case here, BRCC came up because it was a recent IPO and because it was near 52-week highs, even though the market wasn't in a big correction. So that came up on my general scans. And then I always dive into what is the company, what do they do, what's different about it. And if you look into BRCC, it's just a really different concept. They have coffee. Now they're opening coffee shops. It's direct-to-consumer coffee up until now. But if you to get into the coffee business, which is very commoditized, I mean, there's a million coffee shops, you have to be doing something different. So, Starbucks brought that Italian flair of Italian espresso. And what is BRCC doing? Well, I think they're basically the kind of rock star type feel brought to coffee. So it's a company founded by a former Green Beret. It's majority veteran owned. Everything about them is comedic. It's about kind of military, and their new retail chains are called Outposts, and it's got a completely different vibe than what you think of a coffee house, which is then they sit down with a book, and you know their commercials are guys shooting guns, and it's just a totally different vibe. Basically, kind of like the new version of like the bar where guys would hang out. Instead, maybe it's this aggressive type of coffee shop. So it definitely had the great story. Sales have been booming and compounding. So it had great fundamentals. It had great relative strength. And so then once we kind of topped and started to pull back, this was already on my radar. And when I saw this great 3-touch trend line, so we touched the trend line once, twice, a third time here and backed off. When this broke higher, I got long at this 17, I think it was 1710 or 1715. And I always put on positions usually in thirds. That helps me because if the trend develops, I end up with a full position. If the stock kind of just moves up and rolls over, I have a very small position. So it's my way of protecting my account from adverse risk shocks after just putting on full exposure. And trust me, if you invest long enough, it's happened to me how many times, especially even trading pro. I got this big position. It looks great, and after 4 o'clock, they announce a financing or an analyst downgrade. Something bad will happen somewhere. So I learned to basically stagger myself into these positions. And so that was my first entry. After we had a run up here, we had what I call a mini coil. I think I spoke about that at the Trader Line conference last year, where it's basically at least a 3-bar pattern. And so when it broke above this pattern, I added to a second position. So at that point, it was probably about 15% of my account. And we had this super strong move. Now, it's interesting how you kind of go through things long enough. If you make these rules, I always tell people, if you go through something and you made a mistake or something happens, make a rule for it. So in the future, you don't make the same mistake. So I actually, when this ran up here, when this opened up this day and turned negative, I sold half my position as it went negative, and I sold the other half below the low of this bar. So an average price of about 30 and a half. This is really a great trade. Now, people ask me, why did you sell at that point there? Well, if you go back to INMD, which was a great stock in 2021, was one of the big leaders, I had actually traded a very similar, so this is just the recent chart. It's been a big winner. But if you go back to the recent IPO here, we kind of ran up, made our first little base, and we had this huge run up. And I was invested here. I had bought, this is pre-split, so it wasn't $16. I think it was 30 something. I forget what. I don't remember if I bought on this breakout here or here. I think it was down here. Anyways, I had this big gain. And I had added, I think, on the gap up, so my cost had come up, and it was just like this big runner. I was so happy with it, and all of a sudden, in 3 days, we went from 29 to back down to 20. And because I had bought higher, like I went from this being this huge trade in such a short period of time to being barely profitable. And I think I didn't sell. We got this bounce, and anyways, by the time I finally got fed up and got out of this thing, I think I didn't have a lot of profit left. So I said, okay, let me go back and study all of these recent IPOs. And I kind of tore apart as many examples as I could. And I saw that a lot of these IPO bases will have these very strong 70 to 100% rips. And then because there's so many people with stock from pre-IPO, insiders, venture capitalists, there's going to be this wall of selling that's going to come. And even if the stock is going to have a bright future, like InMode eventually went much higher, like we saw afterwards. Let me just bring up that chart again to show. Doesn't mean the stock is by any means finished. Look how much higher you went afterwards. But you had this huge rollover. And I mean, I would never sit through a drop from 30 back down to 7. And there were many of opportunities to buy it back in 2020 anyway. So I realized, wow, there's something with these IPOs. And so I made this rule. Whenever I have a stock and it has this quick 70 to 100% run, I'm going to sell into it. And if you take a look at, I was looking at Curiosity Stream recently. I was talking to the members of my pro membership. I was showing them a recent example as well. If you take a look at this IPO base, this broke out from about $12 and it had this quick move to 22, 24, about again, a 70 to 100% move. And then you totally rolled over and you got creamed. And so if we bring up BRCC again, just to look at how I applied that in real time, is we had, again, this great IPO base. We had this run from about 20 to 34, wasn't exactly 100%. It was more in the 65, 70% range. But when I saw this nice gap up and go negative as the market was actually strong that morning, that change of character, I took half off and then I took off the rest below this bar after the reversal. And so it ended up being a great trade. But if I wouldn't have had those extra rules in place, look how quickly a great trade turns into probably a break-even trade or worse if this keeps falling. And, I think that's why it's just really important whenever you go through these different scenarios. And if you trade long enough, I feel like you're going to run into everything possible. It's just the way the market is. Make a rule, learn from it. So in the future, you can adapt and you can not make that same mistake again.
Yeah, I think that's great. And another resource for learning to trade IPOs, which kind of says the same thing that you did, is the Life Cycle Trade by Kathy Donnelly, E. Bobach.
Mm-hmm.
They talk about trading the advanced phase, the IPO advanced phase, which is this first short run from the IPO base. And then often the stock rolls over, as you talked about, enters a longer term base. We're seeing this with Roblox recently. I don't even
Right.
think it had a great advanced phase, but a lot of stocks just go dormant, and maybe they recover, maybe they don't, but they're going to need
Mm-hmm.
time after that IPO
Right.
move before they set up again.
Yeah, you have to just understand the dynamics of these stocks that are IPOs. There's a lot going on that usual stocks don't have. So once stocks are widely distributed, the shareholders have been broadened out. There's a lot of holders. It's more liquid. When you're first coming to market, you have the underwriters who have extra stock they want to get rid of. You have people who they were a secretary or a programmer at this company, and they have this cheap stock and they want to go buy their Porsche. So they're going to just dump their stock. They don't care. They just see a higher, stock price. They don't care what the prospects are. They see this windfall profit. So you have this, or this venture capitalist who funded them on an A round or a B round, and they're up X amount. They need to lock in these gains for another proposed offer. So there can be this wall of selling that's going to come, and you have to realize that. And I think part of, again, my years trading pro, oftentimes there were a lot of mining companies I would finance, and I would, subscribe to these deals where, I'd get the stock and warrants, et cetera. And I got a chance to meet and talk with a lot of CEOs. And it's just interesting when you get on that more the investment banking side of things, how the mindset is just different from a trader or an investor. And so I think that helps too. The more you can read every part of finance, whether it's underwriting, investment banking, market making, again, that happens to be my passion. So it's easy for me to kind of pour through all these books. But when you can understand the perspectives of all the people involved in the business, that can kind of sometimes give you a better understanding of why would I sell this IPO up 70%, but other stocks I should hold on to it. And understanding those dynamics really makes all the difference.
Yeah, and also doing what you said you did is after you didn't quite handle in mode as perfectly as you could have,
Mm-hmm.
you were determined to find out why and how you can do better the next time. So you went back and studied all
Right.
those examples. So I think that's super important.
Right.
And I'd love to go through some now commodity names and talk about how
Sure.
you handled those and also discuss your adaptive RS, which I think is really interesting as well. It's a good way to determine, what stocks are really showing a lot of strength.
Yeah, so I actually developed this. It's probably been 10 years in the making, and I developed this because I found, even though I did my CMT and I learned all these tools, I never found a relative strength tool that was able to help me when I was dealing with stocks in kind of special situations. So by that I mean, when I was trading a lot of these mining companies and et cetera, they were in their own world. They had nothing to do with the S&P. It wasn't, the S&P wasn't a good benchmark, or I was trading them short term, so the long term relative strength didn't make sense, or their volatility was so crazy. Like some of these junior mining companies, whether it's gold or oil, that it wasn't a fair comparison. Whereas if you're looking at a utility company or a bigger tech stock, so I needed to make something dynamic. So over the years, I just kept staring at these things day by day, and I'd look at gold, and let's say gold was up 1%. I would just know through inherently staring at these things that, oh, this stock should be up 3 or 4% today because it's a good gold move. And eventually I started to kind of try and quantify that and get through a mathematical basis. And I ran into the statistic beta, which, it's pretty well known in the financial world, where basically it shows how correlated your stock is to the index and what the respective volatility is. So for example, a beta of 1 means that if the S&P, if your company has a beta of 1, if the S&P is up 1%, you also expect the stock to be up 1% and be up. If the stock has a beta of 2 and the S&P is up 1%, you expect the stock to be up 2%. If it's a beta of 3, you expect it to be up 3%. So it's like a multiple of the benchmark move. And so once I had that, basically I realized, okay, so what I'm inherently seeing on these mining stocks is I'm inherently understanding what their beta is. So once I started to quantify that, then I would look at these stocks day by day, and I'd say, okay, gold's up 1%, we should be up 3%. If I saw the stock only up 2%, most people say, hey, great, we're outperforming gold. But I say, no, it's not really outperforming. We should have been up 3 or 4%. We only went up 2. And so again, doing my CFA, I realized, what I'm looking at is actually called alpha. But again, these are basic concepts. But I studied economics in university, so I didn't actually learn these basic financial concepts. I learned them with my CFA afterwards. I said, okay, so that's alpha. And so I realized that's really the best basis to understand relative strength, because with that beta tool, it weighs the volatility of the stock versus the S&P. And it also factors in the correlation. Does it go with the market, against the market? What's the relative volatility? And so then when I start to calculate that alpha, that's what you can see in this tool down here. When you have a blue bar, basically the stock is showing alpha. It's going up. It's not only going up, but it's going up more than it should have gone up based on its beta. And the red is, not only is it going down, but it's going down more than it should have. So there can be days like, for example, we have this red candle here down the day, but you actually showed positive alpha because it should have fallen more than it did. And that's like the basis of the tool. But I realized that wasn't enough. It took me about 10 years to kind of build the right composites to get it to work properly. And the final result is what you see, this blue background. And so I went back, I did a lot of studying. And so basically when this background is blue, you have this strong relative strength on different time frames for an accumulation phase. And when it's white, there's no significant relative strength. So you can see here, as it was in a corrective phase, it was a white background. And then right down here, as the market was actually peaking and coming lower, this is the S&P in the top chart, Mosaic was actually showing a lot of relative strength. Now, if you actually look at their earnings, in sales, they have record earnings in sales already. And now with the war and kind of restrictions on exports of fertilizer from Russia, et cetera, their profits are only going to be stronger. So we had this great fundamental basis. We had these record fertilizer prices. The company was making record earnings. And then when I saw this great relative strength background, I said, I really have to figure out how I can get into this company because it's really doing something special. And so I used one of my techniques. I called it a failed breakout pullback. So when you break above a prior basing structure and you pull back quickly to a 20-day average, that's where I buy it on the 20-day. That's just after years of, like I mentioned before, buying these breakouts and getting hurt and saying, I know I shouldn't be buying it, but why am I buying? I finally realized, I'm going to use the breakouts to my advantage, and I'll wait for those failures to come back in and buy it that way. So I actually put my first position on right here. We formed another one of those mini coils I spoke about prior. I put on more exposure right here, and my last piece right here. So this is a fairly large part of my portfolio now, and it's been a great run. So I know people are complaining that, the commodities are choppy, but if you buy them properly, this doesn't look like that much of a choppy chart to me. This has been a pretty awesome advance. And that's kind of how I kind of bring the whole system together. And also in terms of getting beyond just buying, you're starting by looking at what are the fundamentals? Is the company growing? What are the unique situations that are driving these fundamentals? And that's a whole other video. I can get into the commodity demand and supply of this. And then once you say, okay, I have these great prospects, the company's executing, what's the price action saying? So that relative strength, this adaptive relative strength came up really early in the basing structure. And then you had those great alternate entries that I kind of developed and put that all together, and you get this really powerful trend. And in what is a terrible year for most tech and the market in general, this is getting close to a double. So, I was able to, fortunately catch that, Black Rifle Coffee. A lot of the commodities are working. So if you can still be nimble enough to go where the market is telling you the strength is, there's still profits to be had. But again, you have to get beyond just the buy signal. You have to look at the whole system and have everything guide you to the right spot.
Yeah, perfect. And I think the adaptive RS is super cool. And in terms of the commodity space now, a lot of them are kind of setting up. If you bring up Oxy, you've got kind of another base forming. Now we're a little bit more extended to the run. So what do you kind of look for to potentially identify a character change where maybe these stocks will stop leading? What are you kind of watching for on the sell side to potentially sell your positions?
So most of my selling tools when I'm in a big winner really go back to William O'Neill's methodology. I brought a lot of short-term tactics that I didn't learn from his stuff, but the really big picture stuff, it's a great read. You have to look over his stuff. So if you go back and you study a lot of these companies, they usually there's only two ways they can end. Either they kind of go into this climax top where people get euphoric and everyone just chases and runs into these things and you want to sell into strength, or they just eventually run out of steam, the trend ends and they break lower and you have to sell it onto weakness. So one of the tools I kind of developed here, I'll bring up a weekly chart. I developed this tool here. This shows, it's fairly simple in concept. It just shows you how far the stock is from the 10-week moving average in percentage terms. So if you see here, at this point here, this is MicroStrategy back in 2021. If you look at the scale on the right, you'll see it was about 138% above the 10-week moving average, which is fairly significant at this point here. But what I do different than most tools that look at the difference from an average is most tools look at where the stock closed versus the average. The problem with that is if you look at a week like this where we closed significantly off the high, you wouldn't notice that at one point during the week you had this blow off move, which is very important. Actually, if you bring up First Majestic Silver, you'll see here, look, this week here comes up on my indicator as being very extended because the high of the week was very high. But if this would have been looking at just the close of the week, it would have been, actually pretty close to the 10-week average. So it's an important thing to pay attention to. And so I just make the indicator look at the high of the week rather than the close. Mm-hmm. And so you'll notice most of these stocks keep a fair distance from the 10-week average in their bull run. So you can see at this peak here, it peaked out at about 70% from the 10-week average. This year we peaked out at 87%. And this was the real outlier. So once you were a significant distance from the base, you had this real acceleration, much higher than any other point in the trend. And that was a point that we have this climax top now on the top, and we have to get out of it. So that's one methodology I'm looking at. If we take a look at Mosaic, for example, currently, so we're experiencing, So we're experiencing, it's an elevated level from the 10-week average, but we're not really in climax territory. First of all, there's different rules I use. It has to be a certain number of weeks out of a base. So, these first weeks look high, but you're just breaking out. So you don't want to mistake a breaking out phase for a climax phase. So a certain amount of time has to pass. But beyond that now, we're still within the realm of normalcy. So if you see a point where suddenly, rather than being 30 or 35%, above the 10-week average, we suddenly get it to be 50 or 60% above the 10-week average, that'll be a sign for me to say, okay, it's accelerating so fast now that maybe the trend is reaching its climax phase where people are just chasing into it, and now it's time for me to exit. So that's one way I'll look to exit on the upside. The other way, which is a little simpler, if you take a look at Peloton, all of these great trends, sometimes they just run out of steam. Mm-hmm. Just bring this back over here. Sorry for all my old drawings here. Let me just remove this here. So if we take a look at Peloton here as another way that things can top, so this never really went climactic at the end. You can see this kind of stayed, a normal distance. It stayed within trend. And so the way you would have exited this kind of position is eventually you broke the 10-week average here, this red line, and this kind of just broke lower, and it ended its trend. Sometimes you have to just sell defensively as it breaks lower and that it runs out of upside. And that's another way that these trends end. You saw that in a lot of the stocks, that topped in 2021. Same with Fiverr. This never really got into a climactic period. So you actually just sold it as it broke its 10-week average and volume picked up. And so that's why, again, you always want to have variations on how to buy, variations on how to sell, know when to hold, because into a climax top, but it doesn't have a climax top. Well, if you're still, holding Fiverr for this climax top, you've now given back most of the gains. And if you take off the logarithmic chart, it looks much, much worse if you actually look at how much of the gains it gave away. So it's important that you have ways to sell into strength and ways to sell defensively if you have to. So with the commodity space, Mosaic has been a very nice stock for me this year. It's currently my biggest position. And I'm either looking for that climax run. It's always nicer to sell into a big, strong up move. But if not, then we have an eventual breakdown. That's how I'll finish the trade.
Perfect. And just like how you kind of buy in pieces, you also sell in pieces. So sell if it, breaks maybe a short-term moving average in the 50-day, 10-week, or do you just kind of sell it all when it first has that close below the 10-week or close below the low that it breaks at 10-week?
I try to sell all at once. There's rare situations like BRCC. These young IPOs are so volatile that it's harder to make a decisive decision because, day to day, there's these huge significant swings. But usually when I've been a more established stock, we've had these significant uptrends, I like to kind of sell the entire position, break the mindset, because first of all, you have to force yourself to really pay attention to what you're doing. If you're selling in pieces, it's so easy early in a trend to say, let me take a little bit off. And then it goes to this huge trend and you took off so much so early that you're stuck with a small position when it should have been your heaviest position. So When I'm holding the stock, I'm actually always thinking, how can I add more to this winner? How can I add more to this winner? Because if you catch that right trend and you're significantly exposed, that's how you get those monster returns. You don't get 300 or 400% returns by having a small position in a winner. So just in terms of mindset, until I see significant sells, I'm actually always trying to add to a position. How can I add safely? And once I do see that sell signal and it's significant, I want to sell completely because I want to break that mindset. Now, if I sell only partially, the issue is that you have this mindset where you had this great winner, You're probably going to become a little bit emotionally attached to it. You probably bought some gear from the company, a t-shirt or a hat to celebrate. And so, you then after it causes your emotions to get into the mix. So once,
Right.
and I've noticed this, sometimes I'd be in these terrible trades. That's even when I was trading pro or I'm day trading the stock and I have this position, I know I should have sold, but I hold and I finally sell. I take a 5 minutes, I go wash my face and I look at myself and I say, what was I doing? Why didn't I sell? It was so obvious it was a sell. But when you're in the trade and you're emotionally connected, you don't think clearly. So when
Yeah.
you see your proper sells, if you just completely exit and you give yourself a day or two to realign your mindset, you'll look at the chart so much clearer and you'll dramatically reduce the risk of jumping back in too early or making any other number of huge mistakes that you can make. So that's why I like to kind of break the trade, break the mental connection, the emotional connection, kind of restart over and get back to emotional neutrality.
Yeah, makes sense. And are there any other names in your portfolio or stocks you're watching that you think are worth going through and talking about, their setups, where you bought them, and how you're
Sure.
managing risk on the name?
So we could take a look at some of the coals. These are stocks I put on just very recently. And I think this is where you really want to pay attention to the change in volume profiles. You'll see like Arch Coal, and you can see how it's really a whole industry group. First of all, I just want to mention how even though it's a coal company, this chart looks just like any other tech company because you're in the accumulation phase. So I mean, it's been acting beautifully. But look at how the volume really swelled on the upside. You had these huge volume spikes. If you bring up BTU, another
Hmm.
coal stock, huge volume spikes. Like William O'Neill would say, it's not your aunt down the street doing that kind of buying. That's significant buying. If you take a look at Warrior Met Coal, again, big volume coming into the stock. So you're seeing all of these nice volume surges come in. So if you take a look at Arch Coal here, now it's Arch Resources, used to be called Arch Coal, you'll see that all of the up legs had this adaptive relative strength showing you that, okay, this is doing something different. It's being accumulated. Even though it's going up, this is being accumulated. Even as the market was topping and rolling over, this was telling you that with the blue background, this is being accumulated. And so I didn't catch actually on this up leg because I was exposed to other things at the time. This is a trade I put on recently. I don't know if it'll be a smashing success or not. We'll find out with time. But all the same techniques are there. So that same kind of three test trend line I used on BRCC got me into that same entry on this stock, and I added a little bit more. And so the patterns are the same. If you look at Arch Resources, most years, if you look a couple of years back, they were making about $12 or $13 in earnings per year. Last quarter, they made $12 a share, just about. So what they made in one quarter, what in most years they would make. Yet when that earnings came out, it was trading at about $120, and in past years, it was also trading at about $110. So I think the market, sometimes you can just see the market is not appreciating a situation or not properly valuing the earnings prospects. And given kind of the sanctions with the war between Russia and Ukraine, and that they're limiting, the acceptance of coal from Russia, well, Western producers are obviously going to have a much bigger market and higher prices to sell into. And so I can see this going probably significantly higher if that situation persists. And all the same dynamics took place. You had this great fundamental story. In this case here, rather than being a great new product, it's a great new industry situation going on. You had that relative strength, you had the chart patterns, and by proper position sizing, I have between Arch and BTU, I have a really strong, significant portion of my portfolio exposed to these coal stocks. And if we have this big move, my risk is always limited. But if these things double or triple, which given their earnings, it's a possibility, I'm exposed to a lot of upside. So that's kind of what you always want to be thinking. You want to get enough exposure safely so that, hey, if things go well on the upside, it's a huge win. If things go poorly, it's a small loss. You move along. I'll go to the next trade. Doesn't hurt you too bad. And by legging into positions slowly, you get the best of both worlds. But
Hmm.
to do that, you have to have a bigger picture in mind. If you're just looking at swing trading, it's very hard to leg in because by the time, rather than be putting on a second, piece, you're actually taking it off. So the kind of strategy logic won't work that way. So by kind of joining my swing techniques with kind of William O'Neill's position type strategy, I've been able to build this hybrid approach where I can kind of use the safety of swing techniques and the flexibility of swing techniques, but try and capture these outsized moves with size.
Yeah, makes sense. And if you waited for just the base breakout here, you're buying today, and it's already
Right.
extended from the buy point back down earlier where you were looking at it. You had the DTL break, you had the moving averages curling up under price, the 10-week moving average as support, which is that stair step.
That's right.
Yeah, yeah,
Yeah. Yeah. And, again, how do you find this? Looking in retrospect, that's the difference between, I think, trading effectively and just being good at looking in retrospect. In retrospect, it's easy to pull that up, but to find that in real time, a lot had to come together. You have to understand the fundamentals of the company. You have to understand relative strength. You have to understand price structure. You have to understand the volume implications on the weekly chart, like I noticed. You have to understand, why coal, why now? What are global macro reasons for that? So what seems so simple, and that's the unfortunate deceiving part of trading. And again, I've been there. You just pick up a book and like, wow, this looks so easy, and then you go to apply it and it's chaos. It's that experience and having that global understanding of how to put everything together in a cohesive strategy makes a difference from it being just, oh, that was so simple in the past, but in the real time, like with the fog of war, like I call it, like not knowing, it's always easy to be that armchair quarterback, but in real time to actually be Tom Brady is not so easy. And that's the difference, so trying to understand how to put it all together in real time consistently without the emotions getting in the way, having the right size at the right time, limiting your risk properly, buying at the right points, knowing when to hold and sell. It's bringing it all together that makes that difference.
absolutely. Yeah, I completely agree. Perfect. So I guess we'll call it quits there. Keep it nice, short and sweet, and focused. Matt, thanks so much for coming on. And I always like to end it off with kind of one last question. What kind of advice for traders in this type of environment do you kind of have to kind of guide them and kind of open up their minds a little bit to, not staying too focused on the stocks that were last year's winners and, looking for those new opportunities out there?
I was reading Market Wizards, and there was the interview with Stanley Druckenmiller. And he was actually a bank analyst early on in his career, which obviously had much better skills than just being a bank analyst. And, he realized that each of these companies in each industry had their own specific drivers. And that's something that opened my eyes early on. And I always try and think that way. So what drives a coal stock? What drives a bank stock? What's going to drive a technology stock? And the answers are different. So, and you have to realize, and there's reasons for that. There's very strong reasons for that. So for example, a commodity company, I don't need to look at 5-year forward estimates as to what's going to happen. If it's an oil company and oil just went up $30 overnight because of a new war, they're going to make more money next quarter than what we previously thought. So you don't have to wait for analysts to raise estimates or for new earnings to come out. So the driver is more real time. It's the commodity price. With software companies, for example, it's about, are customers re-signing up? What's their retention rates? What are their margins? Are they expanding their revenue? Maybe sometimes revenue is more important than earnings because it's a winner-take-all type of market. So understanding what are the drivers of the stocks you're focusing on is going to really help you to adapt to different market cycles, different market situations. It takes time. It takes that extra effort. It takes that extra education. But if you really want to do well in all market cycles, you're going to have to get past what's this buy signal and try and understand what are the real drivers of things. When you get to that point there, I think it'll be more enjoyable. I like the intellectual, interaction of that, and it's going to help you see bigger picture ideas and really become a better investor overall.
Yeah, I love that. I think that's fantastic. Matt, thanks again for coming on, taking the time and speak with me today. I'm sure everybody watching enjoyed it as well. If you did, go ahead and leave a like down below. Subscribe if you're new to the channel. And Matt, where can people reach out to you if they want to learn more about your style? I'll have your Twitter down below as well as Caruso Insights. But is that the best place just in general?
Yeah, CarusoInsights.com. I have a course I put together that covers all of these topics in one video course. And I have my pro membership where I do my weekly analysis twice a week by video call and daily updates, etc. So a bunch of cool stuff there for CarusoInsights.com.
Perfect. We'll leave it there. Once again, I hope you guys enjoyed. Remember to leave a like down below if you did, and subscribe if you're new to the channel. And we'll see you guys in future videos. Thanks.